Welcome to the Chicago Department of Business Affairs and Consumer Protection webinar. Please note, any website or email that I mention will be posted in the chat. For those seeking business license assistance, please visit the Small Business Center here at City Hall or call 312-74-GO-BIZ. Business license can be applied for or renewed online at chicagobizdirect.org. If you are a part of the BACP Entrepreneur Certificate Program, you can get credit for joining this webinar by sending an email to bacpoutreach@cityofchicago.org. To learn more about this program, please visit chicago.gov/business education. Also, this webinar is being recorded and will be available at youtube.com/Chicago BACP. We encourage all attendees to ask questions. Please use the chat to send your questions. There will be a Q&A session at the end of this presentation. Please note that the views, information, and opinions expressed during this webinar are solely those of the presenter and does not necessarily represent the official policies or position of the Department of Business Affairs, Consumer Protection, or the City of Chicago. Today's webinar is entitled Financing Basics. At this time, I will now introduce Hannah to start our webinar.
Thank you so much, Stella and the BACP team. We always appreciate our continued partnership and collaboration. Hi, everyone. Thank you for joining us for our Fund Your Startup into a Real Business webinar. If you want to know the various options to fund your startup, then you're in the right place. My name is Hannah Fernandez, and I'm the chapter chair of SCORE Chicago. SCORE has been around as a resource partner of the SBA since 1964, providing free and confidential business mentoring for business owners across the country. So whether you are a new entrepreneur or you've been in business for a long time, our SCORE mentors could help you start, grow, and scale your business. To schedule an appointment with our mentors, go to our website at chicago.score.org. Now, I'd like to introduce our presenter, Jeff Nicholson. With over 33 years of commercial and investment banking experience, Jeff was responsible for client coverage activities of diversified companies in the central United States. He has had the opportunity to observe and work with managers and owners across a wide range of industries, from large public multinationals to small privately held companies. During 17 of those years, he was also a successful adjunct instructor at both the undergraduate and graduate levels in both management and finance. Jeff, you're on.
Thanks a lot, Hannah. Good afternoon, everyone. I'm going to be your guide today for financing your startup. I very much appreciate everyone listening in. You know, when I was first asked to build this webinar, I thought, really? All you need to do is sketch out your great idea on a napkin and people are going to throw money at you. Well, I guess that's not really true. This is more a quote to start with. Money is like gasoline during a road trip. You don't want to run out of gas. Now, Tim O'Reilly, who founded the O'Reilly Media Group, was the one that made this quote, and he developed the first internet web portal back in 1993. Now, our goal today is to learn a lot more about funding startups. And most people who claim to know don't really know diddly about it. We're going to cover a lot of material. We're going to go a mile wide and an inch deep. So please strap yourself in. Let's step back for a minute and think about the big picture. These are the stages typically in the life cycle of a startup. And there's roughly 9 stages on this slide. And this workshop is only going to deal with the 5 highlighted stages shown with a red halo. Now, most of the stuff you can read, most of the stuff that you can find on the internet, and most of the workshops or webinars that you can go to are mostly about those stages that are not highlighted. So let's dig in. Inc. magazine went to its 500 founders. That's the 500 fastest growing privately held companies in America, and asked them to think back in their first year in business and identify what they believed was their biggest mistake or the biggest challenge that they faced. And these are the top 3 answers. Shortage of capital was 45% of the respondents tapped as the number one answer. And look at number two, it's a distant second. So the challenge here is not enough capital, and that's why this webinar has become as important as it is. Now, the SBA states that the average cost of starting a business is roughly $30,000, and most will be able to successfully launch with well under $100,000. Now, a sound business plan, it includes specific financial projections, including total startup costs. And as you'll learn, estimating startup costs is as much about sales forecasting as it is about expense projections. Investors and lenders want to know specifically where their funds are going to be used in the business. But you've got to begin your funding search with yourself. No one else is going to invest in your business if you're not willing to invest in your business. And we call that bootstrapping. But after that, you have to get out a pad of paper and begin to list other sources that you might be able to tap. And a central objective of this webinar is to help you formulate that list of possibilities. And what form will the funding take? Will it be donation-based? Will it use loans? Will any of the funding options come from sources that require an ownership stake in your business? And as you're pulling your thoughts together on these sources, you also need to cultivate a funding strategy. And by strategy, I mean determining A, the mix of sources you plan to use, B, the specific milestones in your journey that determine how much and when the funding is needed, and C, how do you plan to approach each source in the process? Now, if we go back to that Inc. 500 survey, another question they asked was, how much money did you use to start your business in that first year? And if you look, those numbers aren't far away from what the SBA said. Only 18% replied $50,000 or more, and well over half said less than $10,000. And when asked where did they get money in that first year, 71% said from personal savings. That's bootstrapping. Now, 21%, the second largest source, was from family and friends. And if you add both the personal and home equity loans together, that's 25%. But recognize that that's where the founders were putting their personal fortunes at risk, not just the business. 9% angel funding. But you'll notice that there's no mention of bank loans, and we'll get to that later. And SBA guaranteed loans were only 3% of the total. So with that as background, how should you get started? Well, I would start by trying to answer these two key questions. How much money is needed, and how will it be used? You know, startup costs is an interesting subject. Most people make the mistake of thinking that startup costs only accumulate until the business is launched. And that's not true. Take a look at this graph. The launch date starts on the far left side. And once launched, you still have to cover any losses until you break even, which is where the yellow arrow is. So you're basically covering operating losses for however many months it takes to break even, as well as those costs that are in the startup category. Now, those startup costs also include capital expenditures. So if you're going to be buying a machine or buying a car, that's not going to show up on your income statement. It's going to be reflected on your cash flow and balance sheet. The operating losses we talked about, you're going to have to cover those. And then net working capital. Now, for those of you that are unfamiliar with that term, let me see if I can describe it for you. Assume for the minute that you're a manufacturer and you're going to convert some raw materials into finished goods and then sell them. Well, you go to ABC Company to buy some raw materials, and ABC says, yeah, we'd be happy to supply you the materials, but listen, you're just a startup, right? So you're going to have to pay up front before I'm going to package this order and deliver it to you. So day one, the money goes out the door, and it might take a week or longer for them to assemble the package and then ship it to you for your receipt. Now, once you get it, it's going to take you maybe 2 to 4 weeks to convert that raw material into finished goods. And once they're finished, then you've got a sales process that will take place. And in most cases, if you're selling to an established business, they're going to take terms on you and not pay you for 30 days. But wait a minute, the money went out the door day one. And it might be anywhere from 8 to 10 weeks before you start accumulating any revenue to pay back that raw material purchase. That's what we call net working capital. Somebody has to pay for that inventory purchase day one because you're not going to collect on it until maybe week 9 or 10. And that's a very important part. And that's all reflected on your balance sheet and cash flow statement. You don't see any of that in your operating or income statement. So the reality is, it includes all the operating expenses and other cash outlays. And so there's really the two pieces there, right? You've got the one-time startup costs, and then you've got the monthly operating losses until you break even. And if your startup includes the dependence of your household on its success, then you really have to include your personal living expenses as part of the startup cost of your business. And that's an important component. Now, again, if you take a look at the way this works, break even is when you start financing yourself. So from day one until you break even, that is part of all of your startup expenses that has to be covered by sources of capital. But to complete this exercise, you have to be able to forecast sales, because that's all part of coming to the point of breaking even. So not only do you have to identify expenses like I have to start a website, I've got to print brochures or business cards, those are all startup costs, but you've got to also forecast revenues, because that's the only way you could determine when you break even. Now, here's some thoughts to think about as you're developing those estimates. And the first one is to plan for contingencies or the unexpected. You know, when someone wants to build an office building or a condo, and they want to get financing from a bank to do it, they're working with engineers, contractors, and architects who have multi-years of experience. And yet, the bank won't give them a construction loan unless they have a contingency in the budget for anywhere from 8 to 12% of the total cost of the building. So you have to plan for the unexpected. Don't skimp on necessities. A lot of people will say, well, I don't need insurance now. I'll get it when I can afford it. And sometimes that is a death knell. You can always consider ways to economize later. And you really want to spend time getting a reality check or two. So that's when a SCORE mentor could really become very helpful. If you supply the mentor with your financial projections and the assumptions behind the numbers, they can give you a reality check and give you a sense of whether or not the assumptions you're making make a great deal of sense or not. Now, everybody write this down. www.5minuteclasses.com. 5-minute classes is all one word. Now, you want to look on that website for a YouTube video that's called How to Calculate Startup Costs. I mean, it's a 5-minute video, but it's really very good. And they also provide some suggested worksheets to follow in pulling together your startup cost estimates. But my biggest advice is that if you don't have enough cash to start your business right, you really should wait until you do. And here again, if your household is going to be dependent upon the startup, then you really need to include your personal budget considerations in that as well. Now, you want to know where you can go to get help in assembling all this financial information? Well, SCORE can help you. So you can download from score.org an entire Excel workbook and instructions that will help you accumulate all the information you need to make very successful financial projections. So if you go to that website and in the search box, enter financial projections template, you will see the workbook and you can download it for free. It's a great workbook. It shows you where you input all of your assumptions. It provides you some suggestions on numbers that you could use. And once you complete it, it generates income statements on a monthly basis for the first year and for the next number of years thereafter. It generates balance sheets, cash flow statements, and it even has a break-even tab that you can go to and see what your break-even point is from a sales standpoint. And it provides some ratio analysis that is helpful in understanding the financial well-being of your business. Now, on that same site, you'll be able to download a 40-page user's guide, and that will be very helpful. And there's also a complete sample notebook in there. I think it's Ann's Nursery. So you can take a look at what Ann did in putting her projections together and all the numbers that went into it, and you get a real live example of what this looks like. I really don't think that there's a better Excel workbook on the internet, and this is free from SCORE. Now, we're not going to go through the workbook here in this webinar, but you really need to go to this source and check it out and plan to use it in your business plan, because it'll be a very, very valuable resource to pull together all the financial information you'll need in order to approach people to help fund your organization. Now let's kind of change gears just a minute here. This is a list of what the conventional wisdom would say is the way lenders think. The likelihood that your startup will be financed by a bank is unfortunately slim to none. In over 30 years of banking, I only financed one startup. It was for $1 million loan. And the father of the founder was willing to pledge his stock holdings of $1.5 million directly to the bank so that we could put it in the vault, along with signed stock power certificates, so that if we felt at any moment that the loan was in danger, we could liquidate the stock and pay ourselves off in an instant. That's the only way that I ever granted a loan to a startup with that kind of collateral. But in help you to understand better why that has been the case, we're going to spend a little time here trying to learn how a bank thinks. And we're going to start by thinking about you being an investor. Put on your investor hat. So you're going to buy stock in a public company. And you know that if you do that and that company goes bankrupt, you can lose everything you invested, right? But you do it. You're willing to take that risk because you want to be able to participate in the upside of that company's future. You want to have stock in the next Google or Amazon or Apple, right? Now put your banking hat on now. Now, when a bank lends money, it too could lose everything if the company goes bankrupt. But the bank does not have an opportunity to participate in the upside of the company's future. Its upside is fundamentally capped or limited by the interest rate that they're charging. So they're never going to make any more than that, And as a consequence, they want to be sure they can get paid back adequately in two ways. They want two legitimate sources of repayment. And the first one is always cash flow of the company. So they will take a company's projections, they will look at the assumptions, and they will try to come up with a downside case, so a legitimate downside. They may look at other companies in that industry sector and take a look at what they have done, what they have forecast and how they performed. They will take a look at the company's history and determine whether or not the forward-thinking projections make sense or not. And then they will massage the data themselves and come up with what they think is a legitimate downside case. And if the downside case doesn't have enough cash flow to pay the company, to pay the bank back, they don't go any further. But if it does, if they do believe, well, even if the sales are softer than they project, and if the margins are narrower than they forecast, they still generate enough cash flow to service the debt, and we're comfortable with that. But they won't make the loan until they have a second source of repayment, and that's usually liquidating the collateral. So they take a look at the company's assets. They take a look at the raw material and the finished goods and figure, what can we get for those goods in an auction? They take a look at the accounts receivable from corporate customers that have received the goods but haven't paid yet, and determine how much of those can we actually collect. And then they take a look at any equipment or real estate and determine what they would be able to realize at an auction. And if they don't have enough proceeds from that liquidation to pay back the loan, they won't make it. But if they do, now they've got two reliable sources of repayment, a downside case and a liquidation of collateral, and that's where they will make a loan. But as you see, if you think about it, startups don't have a history. So the bank can't take a look at the forward projections and make any critique based on the company's past performance, because there isn't any. And as far as collateral, you're probably looking to the bank to get a loan in order to buy assets. So there's no assets there to start with. So banks are not going to typically lend to startups, unfortunately. Well, where can you go? Well, here's the start of your list. And each of you should be thinking of multiple sources, not just one. So in this particular list, you've got, on the left-hand side, you've got sources for equity contributions to the company, in which you have to give up part of your ownership in order to get those funds. And those don't have to be paid back typically. And then you've got debt. And that's where you're going to borrow money from certain sources. And then typically you're going to have to pay that back plus interest. Now, if you notice, there's a little asterisk there called guaranteed by the SBA. Now, the SBA really doesn't make loans. They guarantee loans that have been made by banks. So in my previous example, where a downside case looked legitimate, but the bank didn't feel there was enough liquidation value in the assets, so they wouldn't grant the loan, that's where the SBA can step in and guarantee part of the loan to the bank. So let's say, for example, the bank did its liquidation evaluation and said, yeah, we're only going to be able to cover 50% of the loan. And that's where the SBA can come in and guarantee 75% of the loan. And then the bank says, wait a minute, I got 50% of it covered with the liquidation. And if I add another 75% that the SBA is willing to give me, now I've got 125% coverage of the loan. That's not a bad coverage figure. I think I'll make that loan. So that's where the SBA really can be helpful. But again, you usually have to have an operating history in order for a bank to get a loan, so that the SBA could potentially guarantee it. So let's go to this real busy slide. We're going to see this quite a few times going forward. I put this slide together to present to some existing small businesses in Chicago who didn't feel that they were getting adequate access to conventional financing in the last Great Recession. So you'll recall banks were not lending money back in 2008 and 2009. So if a line of credit was expiring, the banks were not renewing them. And if the bank didn't renew your line of credit, you'd go to another bank and they would refuse to take your application. So these small businesses got together and said, SCORE, help us. Our banks are not helping us. We need to get access to capital. Where can we go? So these are all the sources that I pulled together. And what we're going to talk about today are the ones that are highlighted in the grayish blue. These are the ones that have potential applicability to startups. Now, the other clouds are typically applicable to companies that have been in business for some period of time, companies that have had at least a track record of operating history, and sometimes a minimum of 1 or 2 years. So we're going to just focus on a portion of this. And the first one is micro lenders. Now, micro lenders are intermediaries between sources of funds directed towards disadvantaged areas and the actual needs in those areas. And that's why most of these are not for profit and they operate very locally. The Community Reinvestment Act requires banks to lend to disadvantaged areas. So banks will contribute to micro lenders and will even participate directly with them to extend loans in order to get CRA credit every year. And these micro lenders are typically certified by the US Treasury Department, and they're certified as Community Development Financial Institutions, or CDFIs. And there are 950 of them in the United States today. Now, some of these microlender programs also get support from the SBA through the Sba Micro Loan program. And that's where the SBA will guarantee up to 85% of the loans that are extended. And there are 32 of those such lenders in Illinois today. The key here is that your business needs to qualify because of low income or disadvantaged area. And so it's very typically friendly to minorities and to women. And unlike banks, they are much more friendly to startups as well. Now, my experience is that a great deal of this lending is directed towards real estate and real estate development. But it's also available to startup companies for working capital financing and also for equipment purchases. Now, some of the loans are secured and secured with collateral, and that's mostly true of the real estate loans. Sometimes a co-signer will be required, but in many cases, the loans are actually unsecured. And typically the microloans are for $50,000 or less. And as you can see, the rates vary quite a great deal depending on where you are in the United States, ranges anywhere from 4 to 36%. Now, as you can see in 2019, the average loan size for a microloan, SBA microloan that was guaranteed was a little under $15,000 and the rate was 7.5%. Now on that busy slide that I showed you before, I listed Axion, the Chicago Neighborhood Initiatives Microfinance Group, and CFA USA as probably the 3 biggest players in Chicago. And to find out more about micro lenders, you should go to the CDFI Coalition, cdfi.org. And that's the trade group that represents micro institutions, micro lending institutions throughout the United States. So it's a great source for information on that sector. And you can also go to the Opportunity Finance Network, ofn.org, which is a group of CDFIs that have band together to be able to mutually provide loans to small companies and startups. So that's a quick tour of micro lenders. Now we're going to drop into family and friends. Now you remember that with the Inc. 500, 21% of those founding companies used family and friends as a source for funding in their first year. Now, family and friends, believe it or not, will invest somewhere between $50 and $75 billion annually in startups. And that's 2 to 3 times the money invested annually by angel investors or venture capitalists in startups. So this is a very important source of capital. And as a participant in this webinar, afterwards, you'll get a copy of the slides, and with it, you'll get a 5-page family and friends funding guide that was put together by SCORE Chicago. And it's a great tool to help you understand how best to seek this source of capital from this sector and do it successfully. Now, the trickiest part of family and friends financing is that you really don't want to lose money that family and friends have invested in you. So you're walking this emotional tightrope by mixing business and family and friendships. So my advice is to start targeting people who can afford to lose the money that they will invest in you. And this is the most heavily weighted criterion in my mind. As a frame of reference, pension funds and other institutional investors typically will allow only 5% or less of a portfolio to be invested in risky assets. And like it or not, a startup is a risky asset. So if Uncle Fred is a target and he's got a net worth of $100,000, you should not be asking more than $5,000 of support from Uncle Fred, and probably less, because that's what he could afford to lose, less than 5% of his portfolio. But you really want to take money from sophisticated and well-connected people, because they're going to ask you the tough questions that will ultimately benefit your company in the long run. Better yet, aim at individuals that have experience in running their own business. They know what you're going through. And if a family member or a friend has invested in an early stage or a startup before, that's a great sign, and they should be a very key target. But you want to avoid taking dumb money. You know, you want your initial investors, the seed investors, working for you to help make the next round of potential funding happen. They can act as a resource for you, as a way to frame how you approach other people. You don't want to press for money from someone who's uncertain, because they're going to be the first to complain if things get a little rocky. So you want to avoid investors with a high potential to cause drama or stress. There's going to be enough of that in your normal startup experience anyway, right? But once you get a target, you have to figure out, okay, what is my strategy? And here's where I suggest that you really build a relationship with them first. So you take maybe an executive summary of your plan, and you sit down with them to get their reaction. You introduce them to your business concept first. If you've got a complete plan, you can give them the plan and also include with that the validation of the market for your idea, as well as some financial projections, and get their reaction. Ask them to, give a critique, give some advice, get them engaged in a conversation, because you can always ask for money later. But this is where you can really begin to build that relationship first. And I believe that milestones really could be used for triggering events with your potential investors. It allows for a series of smaller funding requests and communication on the progress in between. We'll get to more about that in a second. But most of the capital that you're going to raise from family members and friends typically takes the form of loans. And you've got to decide what works for you, because some might want equity in it. And the family and friends lending funding guide that you'll get will help you kind of sort through debt versus equity from family and friends. But you really want to put your cards on the table. You know, if you've ever read a public company's 10K annual report or an initial public offering for a company once going to public for the first time, they have a whole section in those documents that are called risk issues. So they identify for the investor up front, here are the major risk issues our company faces. And then they describe how the management team is going to navigate around those risk issues or mitigate them in the process. And that's the same thing you need to do as part of your funding strategy, is to talk about the risk issues that you face and discuss how you plan to navigate through them. Now, you want to make sure that you demonstrate your passion and your diligence. But also keep in mind, there's nothing that turns off family and friends more than if you're a little too passionate, kind of on the borderline of being arrogant, so don't do that. But you really need to manage expectations. It's a best practice to send periodic emails or texts, or have updates face-to-face with your backers. You want to be honest about what's going on, that's going according to plan, and what could be better. You may want or need to come back to these people again for future funding. So you want to maintain that relationship and that open dialogue. Remember, no lender or investor likes surprises. So endeavor to alert each supporter of any suspicions to changes from your expectations. And you should do that early on whenever it occurs. Now, this is the milestone idea. Now, this is a list not just for funding milestones, but they're also, kind of key milestones for any business evolution from startup to break even, which is what we're talking about here. So, proof of concept, that's where you have actually been able to determine that your product or service is technically feasible. That's when you can go and say, hey, we've got proof of concept. Now we need to get some money to build a prototype. So that's kind of how you use the milestones. I think key partnerships is another key one. Let's say you need to build a website, so you're going to hire a website designer, and it's going to cost you $500. So that's when you can go back to one of your family and friends sources and say, I've identified a quality website designer, and it's going to cost me $500. And that's what we talked about before, is kind of a milestone going forward. The next partnership might be a marketing firm to help market your merchandise on social media. And that's another one. Yeah, it's going to cost me $1,500. So you go back to family and friends and say, yeah, there's that milestone. And these are examples of the completion of a website, or you got a minimum viable product to be able to retest the market, your first sale. All of these are potential milestones that give you a reason to go back at another bite at the apple to get funding from family and friends. So I really do think that this is a great way to do it. Not everybody does, but it's a way to manage the expectations of family and friends. Now let's jump to donation funding. Donation funding is a subset of crowdfunding. And crowdfunding is raising money through the collective efforts of numerous individuals and institutions that are all coordinated on an internet platform. And so you can see these are probably the 6 biggest donation funding platforms now. But the key thing here is that any money raised through donation funding doesn't have to be repaid. It's a gift. And donation funding has helped more than 1 million startups since platforms began in the year 2000. And like I said, those are the biggest players on the horizon there. Now, this is where a business plan will probably be of little use. These platforms attract donors that are interested in projects They're interested in causes. They're not particularly interested in businesses specifically. So you really have to change your thought process to align with the platform populations. So you've got to have a story that really connects. And a great example of that was a woman here in Chicago that came to SCORE to start a limousine service to transport children from home to school and back for parents where both are working. I mean, it's always a hassle to worry about getting your kids to and from school if you're both working, and this woman wanted to start the business to do that and help out those working couples. Well, as she moved along, it got to the point where she needed to get insurance for her vehicle. The insurance companies basically classified her as a limousine service and were demanding $10,000 up front in order to get insurance. Well, she didn't have that money. So she went to the donation platforms and she told a story that here's what I'm trying to do for working couples in Chicago, and the big bad insurance companies are trying to rake me over the coals for $10,000, and I don't have it. She got the money. So the platforms really, each of them have a little bit a unique slant to them. Many of them offer rewards to the donors that could be, pre-ordering a product or getting a discount on the first run, maybe getting a t-shirt that commemorates the donation, or being on a donors list. So there's some kind of a reward that is most generally offered to a donor. But you've got to evaluate whether the platform's assistance that they provide for a campaign really matches up with what you need. And each of them is a little bit different. But you shouldn't be looking at this donation funding as a one-time event. You should treat givers or donors as stakeholders that may assist you in the future. Just like with family and friends, it's not a one-time event. So you want to maintain some dialogue with the people that have donated. The platforms will give you the donor lists. They'll tell you the dollars that are given, and they'll provide you with vehicles where you can gather contact information, provide updates about your business, and take surveys from them on what they're hearing from you. And going back to the donor population can be very successful. I found a company called Peak Designs, which is a creative maker of outdoor gear. And they've gone back to donor websites 5 times for funding different products that they're introducing. And the 5th time they went, they raised $4.9 million. So going back is a key thing. But the most important advice here that I can give you is that you need to create your own outreach program independent of the platform. So you need to communicate with friends, with family, potential suppliers, potential clients, or interested parties, and bring them to the platform and your program. If you're able to supplement what the platform is able to do by bringing your own population, the chances of your success are even greater. I can't stress that enough. Now, this is kind of a quick snapshot. There's 2 kinds of programs. You've got a fixed program, which means you identify a bogey and probably pay somewhere between 4 and 5% of the money raised as a fee. But if you don't reach your bogey, you don't get anything at all. So if you're trying to raise 50 and you get 49,000, you don't get any money. The flexible program, you also set a bogey, but if you don't reach it, you get the money that you raised. Unfortunately, they typically double the fee. So you're looking at maybe an 8% fee if you didn't raise what you said you wanted. And in addition, there's these payment processing fees that have to be covered. So when people are making a donation, they're paying by charge card or by ACH transaction or some other form of EFT. And there's usually a charge associated with that. And that will also come out of the proceeds that you raise. Now, it's interesting that all or nothing campaigns get fully funded at twice the rate of the flexible ones. But I think if you really think about it, it makes sense, doesn't it? If you know that you've got to raise that $50,000, and if you're $1 short, you get nothing, you're going to bust your hump to get that $50,000. And so that's why it's twice as successful. But overall, the fully funded success rate is only 50%. But all forms of funding, it's a 78% that exceed their goal. So the right mix is important here. Average campaigns raise between $25,000 and $30,000, and it typically lasts about 9 weeks from the time you begin to put your program together to when you reach your goal. Average pledge is under $100, and the average number of backers is usually about 47. And the biggest raise ever was $20.3 million on Kickstarter back in 2015. Pebble Technologies was promoting a new smartwatch. And so they wanted to raise money for marketing this product. And their target for marketing expenses was $500,000. But the company raised 20 million. And I think it was because they were offering some smartwatch discount or pre-ordering promotion. And Pebble Technologies, by the way, was bought by Fitbit 2 years later in 2017. The last thing to mention is campaigns with videos attached to them. They earn 100% more than those that don't have videos. So that's about donation funding. Now let's jump to angel groups. Now, angels are usually wealthy and successful business people who are interested in investing their own money in startups and early stage businesses. So sometimes angels work alone, and sometimes they work in a group. And if you've ever watched Shark Tank, that's probably the best example I can give you of what an angel really looks like and how they behave and all that. What I've listed here are what I think are the 6 top angel groups in Chicago. Now, there is a difference between individual angels and angel groups. Angel groups are more formal, and they typically anticipate being part of a next unicorn or big initial public offering. So the groups are really focused on an exit of 2 to 5 years where they're going to get all or a portion of their money back by going public or selling the company. By the way, seed capital often refers to the first of 4 funding stages for any growing business. So it's that first stage. Now, angels are not interested in running the day-to-day operations. They leave that up to you. And they're routinely satisfied with only a minority equity position in the business. Now, the vast majority will provide advisory support and mentoring support for your business when they grant you the money. And 1 in 3, probably a third of the angel groups will want a board position for important decision making. But they do have this shorter time horizon as angel groups do, and they typically want that exit. Now, the average individual angel investor writes a check for under $40,000, so keep that in mind. Now, those of you that have watched Shark Tank know that the valuation of the business is really a critical part of the success in raising money from angels. And we're not going to talk a lot more about valuation here in this webinar. You just need to know that that needs to be an important component when you go to talk with an angel investor or an angel group. Many angel groups particularly see themselves as filling the gap between raising money from family and friends, and going to a venture capital firm. And in fact, many angel groups will not even begin to look at your application if you haven't raised money from family and friends. I mean, they're sitting there saying, wait a minute, if you can't get money from people who know you, why should we look at the situation because we don't know you? I believe there's a greater chance of landing an individual angel if your business plan is not targeting a near-term IPO. So if you've got a much more patient plan in mind, you're looking for some patient capital, maybe your time horizon is 7 to 10 years down the road, an individual is probably a much better match. But if you have ambitious plans and are a lot more aggressive, then this is the list of things that you need to have in place in order to attract the attention, let alone the capital, from an angel group. So first, your product or service is developed already, or it's very, very near completion. You've got existing customers, or you've got confirmation of people that will buy. You've invested your own capital, you've bootstrapped, and you've also recruited family and friends, as we've talked about. And you can demonstrate through your financial projections that the business can go rapidly in the next 2 to 5 years. So if you think about pulling all that together, you've got a business plan that has to be in pretty top shape in order to go to an angel group. It's definitely easier to find the groups than individual angels because they're actually organizations, right? But in any of these situations, you really need to get introductions in. You need to network. That's why being part of LinkedIn is so damn important. You can find ways to network in to people who are advisors to different angel groups, or they're companies that have gotten investments from angel groups, and you can network into the founder and try to get an introduction. That's the best way to get in to talk with an angel group. Now, the Angel Capital Association, or ACA, is the trade association representing angel groups across the country. And it's a great resource to find studies about angel investing, characteristics of the companies and the angel investors themselves, and white papers that talk about the environment in the angel world. So that's a great source for you. Angel.co is a place, interesting, where you can actually post for a job to work for a startup, or you can seek employees to work for your startup using angel.co. But if you go to this address that has /North-America/investors, you be able to find a long list of individual angel investors in North America. Now, the Angel Investment Network is the largest crowdfunding platform in the angel world. So just like with donation funding, where you've got a platform that is gathering all the potential angel investors to potentially provide some capital to you, they boast almost 250,000 investors across 80 countries. So this is a very big platform. And there's a lot of other things on the website that you might find helpful as well. Well, at this point, we've kind of hit the major sources for startups other than banks. And if we go back to that busy slide, that excess of capital, these are the clouds that we didn't really talk much about, because you really have to have some operating history of some time frame in order to get access to these examples. Alternative lending is a very interesting one. You've probably seen Cabbage advertised. On Deck, for example, is a very large public company now that invests through a platform. Now, these alternative lenders will advertise that they don't charge an interest rate, they charge what they call a factor rate. So you borrow $100,000 and you're going to have to pay, 1.2 times that back in a certain period of time. And that time frame is usually about 6 months. So what they're looking for, believe it or not, is consistent daily or weekly revenues. And the reason is that they take payments out of your account every day or every week on a consistent basis. So they're looking for someone that has money coming in from sales on a very regular, consistent basis. And for that to be true for a startup, you've got to be in business a minimum of 4 to 6 months, and probably more like 12 to 18 months in order to be able to demonstrate that you've got this kind of consistent payment history. And if you look at the factor rate, and I calculated what I think is the annual percentage rate, it ranges between 30 and 50%. So it's a high interest rate. It has to be paid back in a pretty short period of time. However, if you've got a project, this is where a lot of millennials are going to get, call it project financing, so that they can buy some inventory and add a very key customer. I also added this one here. You've probably seen Kevin O'Leary, Mr. Wonderful from Shark Tank, advertising startengine.com. And originally, he said, here's where startups can get money. That's not true. By the way, there's over 50 of these organizations like Start Engine out there, platforms for equity crowdfunding. But in order to qualify to be there, to get money, you have to have 2 full years of audited financial statements just in order to file to be part of that FINRA registered portal. So again, that's out there. And once you get 2 full years of audited statements under your belt, this is another source that might be useful for you in the future. Now, when we first started, I said, hey, the areas that we're going to cover are from startup to break even. And so I've kind of departed from that a little bit, but that's really where the focus has been. What I'd like to do is to go to this slide again and remind you that we looked at microlenders, family and friends, donation funding, angel groups, 4 sources for corporate capital raising that are dedicated to startups, or where startups are applicable. What I'd like to do is to now describe to you how startup funding works. And this is, you'll get a copy of this along with the slides. I had to break it into 2 pieces because the picture is so big. But what you have here is kind of the start on the far left side, and then the company going to an initial public offering on the far right-hand side. And these are the stages that typically a startup goes through from idea generation to IPO. And so you've got the idea stage. That's where you're the founder. You own 100% of the company and you're starting it. Maybe you take a partner and then you kind of split it at the co-founder stage 50-50. Now here's where you kind of, well, okay, I raised money from family and friends. Let's say it's $15,000 that you've raised from family and friends. That's that first round that we talked about, and that they invest before everyone else. Oh, the other thing, this has this option pool thing, which kind of carries through, which is more sophisticated, just confuses things. We're not going to talk about that. The next round is that seed round. That's really that first round. And now you're raising some serious money at $200,000. And that's where an angel investor can come in. And in this case, that $200,000 represents a portion of the ownership of the company. So early on, Uncle Fred gave you some $15,000 and you had to give him 5% of the company. Once the angel investor comes in, then every previous investor's ownership stake is diluted. So now the uncle only owns 4.2% of the company. And you as a founder own 31.2%. And the angel owns a chunk because they put in $200,000. As the company is growing now and wants to really expand and accelerate its growth, it now needs to raise some big money. So it's going to get $2 million in a Series A that in this case is going to come from a venture capital firm. And so they're sitting down and they're saying, okay, we're taking a look at this company, looking for a big investment. We think that the company is worth $4 million after we invest. And so now you can see where the venture capital firm is now the biggest owner. They own 1/3 of the company. Uncle Fred's share is now 2.6, and the founders have dropped down to 19.2. And once you go to the IPO and raise a lot of money, that's where the founder's share is now 17.6. Don't forget, you started out with a co-partner at 50% each. Now you're down to 17.6 because your shares are being diluted by the public offering. But the key thing here is that you began owning 100% of nothing. And over time, you go public and own 17% of a multi-billion-dollar operation. So the reason I wanted to talk about splitting the pie and going through these stages is that at some point in time, as you take a look at the access of all this capital, there's ways in which this stuff fits together. And it may seem like just a whole cup of soup right now, but this is trying to give you a sorting out of how these pieces can typically work together over a period of time to work with a company that is going through an accelerated growth phase. Well, our job today was to learn a little bit more about how to fund your startup. And I told you we were going to cover a lot of material, and I hope that we helped answer that question. If nothing else, I hope I got you to think. Again, you'll get a copy of that funding slide on one page and a family and friends funding guide, financing guide, along with the slides as a follow-up to this workshop. I want to thank you again for signing on. I appreciate your listening in, and I will stay and answer as many questions as necessary. Thank you so much.
Hannah and Jeff, we have a lot of questions. So what I would do is I'm going to ask the attendees to raise their hand. That way they can ask their own questions. So we're going to start with Tanja White, I believe. Go ahead, you can speak. You've been unmuted. Go ahead. Okay, we'll go to Carol Smith. Not too sure. Let's see what else is going on. We have 100 and before we ended, we were at 171 attendees. Can you please share the website address again for the YouTube? I believe that's for me, Chicago. It's youtube.com, Chicago BACP. I am the founder of Soul Past Bath and Body. I'm curious about how to determine what stage of business I'm in now and how that translates into how much I should ask for and which sources I should spend more time pursuing.
Well, I'm not sure the stage that you're in is as important as kind of identifying, as I suggested, the milestones that you're anticipating in your business. And each of those milestones has potentially a cost associated with it. And that's where you begin to identify how much you need and why you need it.
Sharon, you've been unmuted.
Yes. What if you're not going into business to sell something, you're providing educational services? Which of these lenders would you recommend in terms of how would you measure your educational success in terms of getting loans and financing?
Well, the only difference between a service-based company and someone who's making a product is really the asset structure. So from the standpoint of raising money, a service business, usually the only assets they have are accounts receivable. And maybe there's some patented information or intellectual property that might be of some value as collateral, but typically it's just the accounts receivable from the people that are buying your services. So that's where, you know, a micro lender and family and friends can be very critical to getting some traction so that you can build a customer base and use kind of recurring revenue as a reason for being able to get other sources of capital to finance your growth. But originally, from a startup cost standpoint, it's really for services, it's really going to be bootstrapping and family and friends, or donation funding too. If you can really create a good story that connects with people, those are your three top sources.
Thank you.
Bianca, you can go ahead and ask your question. You've been unmuted.
Hi, thank you. So I am actually in the beginning stages of opening a franchise. I've already invested a portion of my own savings into the franchise fee. So I'm in the very beginning stage where I'm still looking to get funded so I can find a location and everything else that needs to take place. So I guess my question is, this may be a two-part, but is there specific micro lenders, angel lenders that might deal more with franchises? And then two, isn't it a little bit of how do I put it, even though my specific franchise has not been up and running, does it look better and stronger coming from a franchise, seeing that other locations have been successful and they have, you know, income coming in and they're growing, a growing franchise?
Mm-hmm. Well, first of all, some of the major franchise organizations have very profound lending arrangements with other lenders. So, for example, you know, talk to McDonald's or Burger King and that sort of thing. So there are banks that have teams of people that only focus on lending to new franchisees for those franchise organizations. So the first place to start is with your franchise organization and asking them where they have any relationships for sources of capital.
So I did that.
Yeah.
Unfortunately, because they operate in another state, their go-to lender can't operate here. He did refer me out to another lender, but again, it's a bank. So I was having the issues of what you mentioned earlier, no collateral, no, years of, like the business is not up and running. So I don't have 6 months to a year of revenue to show them that we've been successful. So I've been running into those problems. So I was leaning more towards like an investor or, angel investors are going that route. So like the second part of the question is I have completed my business plan, but I got advice from someone that helps with small business owners. Is they said that I did break down a list of where the funding, what I'm asking for, like the description of every line that is needed, but they said I should get more in depth of, instead of putting like equipment and the build out, get specific, like what type of equipment and how much does that cost for like the laser hair removal equipment. Like I guess my question is, do I need to get that detailed as to where every single dollar is coming from, or is it okay to like something together?
I can't answer that question honestly. But I think the fact that you've got a franchise organization that operates only within one state, and you're trying to do a beachhead, if you will, here in Illinois, it really creates a difficulty. I think the franchise organization should be able to help, and you going to a micro lender might be useful. But the only other advice I have for you is that there are franchise consultants out there that do nothing but consult with new franchisees on how to get funding. And so they may be able to provide some access to sources that are uniquely focusing on new franchise situations. And so looking on Google for franchise consultants might give you some help. And also talking to Score Chicago, I think we know of some people that are in that.
Priscilla, go ahead with your question. You've been unmuted.
Hi, I wanted to know, I have a business where we sell body products, and right now we are at a standstill because we have run out of funds. And I wanted to know, where can we get funding for our business? Because everything that we have made as far as revenue has gone back into making more products. So now we're just like completely out of our own money to invest back into the business. So I wanted to know, where can we look in terms of how can we acquire funds to buy more product, buy more equipment, and keep our business running?
Well, you're in a situation that's not too different from actually being a startup, because you're out of bootstrap and you're looking for other sources. So that's, micro lenders, donation funding, and family and friends are the three clear places where you should try to get some money in order to get to a certain place. And you need to identify what that looks like. So you need to be able to say, here's how much money we need in order to get to, and I think you want to get to a place where you're back to where you're self-funding again. And that's the journey. And so you need to articulate that to these other sources of capital and see if you can raise the money that you need in order to get to that next milestone.
Dan, go ahead. You've been unmuted.
Hi, Jeff. I just have two questions. One is for when I register for this course, always get a question: are you in business or not? I start up my business five years ago. Actually, is a very active working for a dedicated project funding from from the government, and then so during the 2020, just it's about 20 millions. The startup funding just say more like to consolidating, but due to the COVID, so it's postponed. And then to now, I updating, keep actively working on that proposal. And then, so one question is, should I put my business in business, or is no, or not? And so if we have another choice, I put myself as a startup, because besides this funding, startup funding coming in, I don't have I'm not working for other revenues. So that's only the expense I put in. So my question is, first is, what should I put in business or not in business? And then another second question, if I put no, not in business, it will be impacting, what impact will be the huge funding coming. That's what I'm dedicated to apply for that one.
You know, I don't know how to answer your question, to be honest. I mean, it sounds like you're in some form of consulting project business,
Yeah,
and it involves the government, and the government kind of put things on hold because of COVID.
right.
And you're trying to figure out how to kind of restart that.
That's a is the I support the government some project problem solving. So that's at the beginning I dedicated to in the trade conflict between U.S. and China. So they agreed to accept some proposal, and then to set up some grant to start up that project. Actually helping both countries trading business. And then so that's during the COVID, because they're already
I understand. Let me just kind of cut to the chase here. I think you've got a very specific and government-based question that I don't feel comfortable in answering. So what I would suggest is getting in touch with SCORE Chicago and trying to find a mentor who has some experience with grants and government projects, and kind of present your situation in some detail to them to see if they can help sort through what the next steps should be.
Patricia, you've been unmuted.
Hi, can you hear me?
Yes.
Okay, so I'm a union carpenter and I've had my business, but I've had it on hold. And so I have, like, savings and funding and stuff like that. But like doing the DBE certifications and the WBE certifications, when I'm making like the business plan and things like that, do I add in my salary as a carpenter? Because since I'm using that salary along with like side jobs.
Well, as a business owner, my advice is always to show a salary being taken.
So I would use, my salary as a journeyman.
Yeah.
When
Yeah.
I'm
There's some startups that don't show anybody taking a salary, and then they break even. in, the 6th month, but it's like they're not breaking even because they're not making any money for themselves. So you got to
Right.
pay yourself. So that should indeed be part of your whole startup financial projections.
Okay. And then say like if I'm trying to bid on projects and I want to try and, get a financial projection for a loan or something, do I add in the project that I'm bidding on, like the equipment, the like the material, the work crew, the David Beckett wages? Do I add all that stuff in there also?
Yes. I mean, that's effectively like adding, a monthly sales forecast for, being on Shopify. So you're putting together your projections, and in this case, it's a project, but you want whoever is going to be providing some funding to you to know exactly where the funding is going to be used. And so that's where you put in the revenue for the project and all of the costs that are associated with it and the time frame, and that gives the source of capital access to what you're really doing.
Okay. And would you have like any suggestions as like for companies trying to get capital for WBE organizations in the construction industry, as far as like, trying to start a major minority general contracting company?
I do not. Contracting funding is a very specialized business. So frankly, there's a lot of banks that don't even lend to contractors that have been in business for 10 years. It's a very specialized nature. So I would certainly want to talk to some trade associations that are in your field, and you probably can get some sense from them as to funding sources that are peculiar to the contracting business.
Okay.
We have a few more questions. Time for a few more questions. Let's see. It looks like some of these questions are just giving each other advice to other attendees.
Well, on the one yeah, they're already been changed. I'm looking at the first email you sent.
Yeah, that's it. They just saying, Jeff, thank you. Great presentation. You gave out some valuable information.
Is
And
that
that's pretty much it.
is that in the chat area or the Q&A?
I'm in the chat right now.
Okay, well, why don't you go to the Q&A and see if there's any unanswered questions that get registered there.
Okay, I see one. I have a remote marketing consultant company. I'm interested in opening a storefront to include print services and create staffing needs. I only have proof of concept with marketing consulting, and I have revenue in 5 figures. What's the best way to forecast revenues for the new business offerings?
Would you read that question again?
I have remote marketing.
Just the last question.
Okay. What's the best way to forecast revenues for the new business offerings?
Well, not having practiced in your business channel, I don't know what the issues are surrounding supply and demand. If this is a business channel that you're comfortable with, sometimes it's just taking a wild guess at what you think potentially revenues will be for individual products or services that you have. You know, I can't go into any detail about how many customers and how many services those customers will buy, because that's all part of your market validation process. And if you haven't gone to the marketplace to validate that your idea will be successful on the storefront, then you need to do that before you commit to renting or buying a storefront.
This is my first time. I've never developed a business plan or a business map before. How do I do that? Will the SCORE financial projection template be enough?
No, the financial projections are just that, they're financial projections. If you've never developed a business plan, I again suggest going to SCORE Chicago and trying to meet with a mentor and have a mentor talk to you about your business idea, and they can be very specific about what should be involved in a business plan. I will also say that SCORE Chicago puts on a couple of webinars that are for creating a business plan. So that's another thing that you could do, is go to SCORE Chicago and look for those webinars and business plans.
If you received an EIDL, can you receive other loans?
EI,
DL.
That's the EIDL, Jeff, the Economic Injury Disaster Loan given by the SBA.
oh,
Yes.
I frankly don't know anything about that. Maybe you do.
The answer would be yes. You could go ahead and get another loan.
Which one is better for fast food, renting or building your own building?
My personal view is to lease rather than build.
And we have time for one more. I worked hard to develop my small business. It's an international travel language service. I was even able to get trademark rights. COVID has really knocked me out of business. Since I had acted as a sole proprietor, I did not ask for funds through the EIDL, which I feel it was a mistake. Any suggestions for me to re-enter my business with any hope of success?
Again, Hannah, maybe you know something about applying now.
I just want to go ahead and verify they applied and then they got declined with the EIDL loans.
I don't see a follow-up. Let's see if she put something
Yeah.
in.
The best way would be, as Jeff mentioned many times, is to go ahead and contact us at chicago.score.org and really sit down with the SCORE mentor, because I know there's a few SCORE mentors who have actually gone and applied for these EIDL loans themselves, so they could actually walk you through the process and share their experiences and give you some tips on what to avoid and what to apply for. So definitely contact us and have a one-on-one.
I don't see any more questions. Again, just a lot of thank you. This was great information, Jeff. And any last words to encourage our attendees?
Keep the faith.
All right, thank you to all of our attendees. If you are a part of the BACP Entrepreneur Certificate Program, please send us an email to receive credit at bacpoutreach@cityofchicago.org. To learn more about our upcoming webinars, please go to chicago.gov/business education. Any last words, Hannah?
Just wanted to go ahead and thank you, Stella, and also Jeff for an outstanding presentation. I mean, one of the things that I want to impart to the attendees is that, there's a lot of candid tips and valuable information today, and it's a lot to think about, but know that you're not alone. The city of Chicago and SCORE Chicago, we're all here to support you. So definitely stay connected with us, keep attending these webinars, and really schedule that appointment with the mentors, the mentoring sessions. It's your taxpayers' dollars. They're free, confidential, and go to our website at chicago.score.org. And, we're here to go ahead and help you. Your success is our success.
Well said, Anna.
Thank you. Have a good evening.
Likewise. Thanks so much, everybody. Stay well. Great job, Jeff.
Thank you.